Hi, everybody, and welcome back to video number 10 in chapter 22. And when we left off, we were analyzing the transactions from the satellite example. And for land, they purchased land in the amount of $60,000 through the issuance of a long-term note payable. The transaction did not affect cash. It is a significant non-cash investing / financing transaction that the company would disclose either in a separate schedule below the statement of cash flows or in the accompanying notes. So they make the following entry to reconcile the worksheet. They debit land and credit notes payable here. Okay, and they show, of course, the T account with the original balance and the two adjusting entries to land. Not technically an adjusting entries, the two journal entries to land. In addition to the non-cash transaction involving the issuance of a note to purchase land, the land account was decreased by the condemnation proceedings. The following worksheet entry records the receipt of $18,500 for land having a book value of $10,500. So in the investing section, we have the proceeds from the condemnation of the land of $18,500 and a credit to land. And in the operating section, the gain on the condemnation of land, which was $8,000, an operating section entry. In reconciling net income to net cash flow from operating activities, Satellite then is going to deduct from net income the gain of $8,000. The reason is that the transaction that gave rise to the gain is an item whose cash effect is already classified as an investing cash inflow. The land account is now reconciled. And as we look at the equipment and accumulated depreciation here, in analyzing that, it shows a number of transactions that affected these accounts. The company purchased some equipment for $53,000 during the year, and Satellite records that transaction on the worksheet as follows. Here we have equipment with a debit and a credit to the investing section, purchase of equipment for $53,000. In addition, Satellite sold at a loss of $1,500 equipment with a book value of $5,500. It records this transaction as follows. The investing section gets a debit of $4,000 for the sale of equipment. The operating section gets a $1,500 debit for the loss on the sale of equipment, and accumulated depreciation on equipment gets another debit of $2,500, total of $8,000 for equipment. The proceeds from the sale of equipment provided $4,000 of cash. In addition, the loss on the sale of the equipment has reduced net income but did not affect cash. Therefore, the company adds back to net income the amount of loss in order to accurately report cash provided by operating activities. Satellite reported depreciation on the equipment at $11,500, and it recorded it on its worksheet as follows. The operating section gets depreciation expense equipment of $11,500, and accumulated depreciation for equipment gets $11,500 here. Okay. Now, equipment, from the additional information, the company adds depreciation expense back to net income because that expense reduced income but did not affect cash. Finally, the company made a major repair to its equipment. It charged this expenditure in the amount of $11,000. to accumulated depreciation equipment. This expenditure required cash, and so Satellite makes the following worksheet entry. It debits accumulated depreciation equipment here for $11,000, and in the investing section, major repairs on equipment, it credits. After adjusting for the foregoing items, Satellite has reconciled the balances in the equipment and related accumulated depreciation equipment accounts. Now, for trademarks, building depreciation and amortization of trademarks, depreciation expense on the building was $3,100, and amortization of trademarks was $2,400, and they're both expenses on the income statement that reduced net income but did not require cash outflows in the current period. So, Satellite makes the following worksheet entry in the operating section. The depreciation expense buildings will be added back to cash with the debit, and operating section, the amortization trademarks will also be added back as a non-cash expense. Accumulated depreciation on the building, $3,100 credit, and trademarks for $2,400. All right, other non-cash charges or credits. Here, if we analyze the remaining accounts, that indicates that changes in accounts payable, accrued liabilities, income taxes payable, premium on bonds payable, and deferred tax liability balances resulted from charges or credits to net income that did not affect cash. The company should individually analyze each of these items and enter them in the worksheet. The following fairly complex compound entry summarizes these non-cash income-related items. So here we have income taxes payable, premium on bonds payable. In the operating sections for the remaining items here, we have the increase in accounts payable, increase in accrued liabilities, increase in deferred tax liabilities, decrease in income taxes payable, and the amortization of bond premium. And the credit is going to be to accounts payable, accrued liabilities, and deferred tax liabilities. And I did not say here that the decrease in income tax as payable was a credit, as was the amortization of bond premium. Okay, the common stock and related accounts. Comparison of the common stock balances and paid-in capital in excess of par for common stock balances shows that transactions during the year affected these accounts. First, Satellite issues a stock dividend of 2% to stockholders. As the discussion of worksheet entry 2 indicated, no cash was provided or used by the stock dividend transaction. In addition to the shares issued via the stock dividend, Satellite sold shares of common stock at $16 per share. So the company's going to record that transaction under number 16. We're going to debit the financing section of the statement of cash flows for the sale of the common stock here, $144,000, while crediting common stock for $9,000 and paid-in capital in excess of par common stock for $135,000. Also, the company purchased shares of its common stock in the amount of $17,000. So under transaction 17, it'll record that transaction by debiting treasury stock here for $17,000, and in the financing section, credit the purchase of treasury stock. The final reconciling entry to reconcile the change in cash and to balance the worksheet is the $7,000 difference between the beginning and ending cash balance, I should say. The decrease in cash then was in transaction 18 was $7,000, and the credit to cash was $7,000. So once the company has determined that the differences between the beginning and ending balances per the worksheet columns have been accounted for, it can total the reconciling transaction columns, and they should balance. Satellite can prepare the statement of cash flows entirely from the items and amounts that appear at the bottom of the worksheet under Statement of Cash Flow Effects. Okay, so now our statement of cash flows can be prepared, and here is all the adjustments to cash flows from operating activities, and we've been through all of these, so I won't go through them again. Here's the net cash used by operating activities, and here are the net cash used by investing activities, and here's the net cash provided by financing activities. So a little unfortunate here that we used cash by operating activities. However, most of that was due to the increase in inventory, which in theory would be used up eventually. So we had a decrease in cash of $7,000. Our cash beginning was $66,000. So our ending cash position was $59,000. And if I go back real quickly, we can see that our cash went down by $7,000 and our ending cash position here was $59,000. As shown here. And finally, the supplemental disclosures, the cash paid during the year for interest, the net amount capitalized was $9,000, income taxes was $47,000. So our supplemental schedule of non-cash investing and financing activities would include this purchase of land for $60,000 in exchange for a $60,000 long-term note. Okay, let's take a look at comparing GAAP versus IFRS. And here, similarities include both GAAP and IFRS requires that the company prepare a statement of cash flows. Both IFRS and GAAP require that the statement of cash flows should have three major sections: operating, investing, and financing, along with changes in cash and cash equivalents. Similar to GAAP, the cash flow statement can be prepared using either the indirect or direct method under IFRS. For both IFRS and GAAP, most companies use the indirect method for reporting net cash flow from operating activities, and the definition of cash equivalents used in IFRS is similar to that used in GAAP. Differences, though, include a major difference in the definition of cash and cash equivalents, and it is that in certain situations, bank overdrafts are considered part of cash and cash equivalents under IFRS, which is not the case in GAAP. Okay, so under GAAP, bank overdrafts are classified as financing activities. IFRS requires that non-cash investing and financing activities be excluded from the statement of cash flows. Instead, these non-cash activities should be reported elsewhere. This requirement is interpreted to mean that non-cash investing and financing activities should be disclosed in the notes to the financial statements instead of in the financial statements. Under GAAP, companies may present this information in the cash flow statement. And one last difference, one area where it looks like we'll have to come back to this in our next video. And when we return, we'll finish off this video. Until that time,